Hello, everyone. This is Dr. Gregory, and this is ACC 4620, Auditing and Assurance 2. This is the last video lecture, Auditing and Reporting for Financial Statement Audits, Chapter 15. Now, the AICPA, the PCAOB, and the IAASB have similar but differently worded standards. So you want to dive into that a little bit and understand what the differences of these different governing bodies are as far as the expectations of an audit. I'm going to go through the AICPA's rules, which is the first one, forming an opinion is an unqualified opinion. That means that the financial statements are presented in accordance and conformity with GAAP. They're free from material misstatement. They may identify matters of interest and other matters. So matters of interest is maybe some uncertainty of a future outcome. For example, litigation. There may be litigation on the books, but we don't know what the outcome is because it may be so early on. We might bring that up, but it doesn't change the unqualified nature of the financial statement. There might be some significant transactions with related parties. Again, just because it's a related party doesn't mean that it's an illegal or fraudulent action. So you have to look at those actions, but you might want to bring up that because it's a related party of some type within the organization, you might want to be looking for some alternative or substitute relationships. We may identify, as I said, other matters, something that's not disclosed that an auditor may feel is relevant to the owner's understanding of the financial statements. The auditor is unable to withdraw, but they can't provide an opinion. That's another matter. Maybe there's a scope of limitation. Now, the other three types of opinions that auditors can provide are qualified, and we call those except for opinions. And we use that language, except for, or with the exception of, everything's okay. Basically, we're saying everything's okie dokie except for something. And usually it needs to be fairly minor. It can be material, but it cannot be pervasive or rise to the level of an adverse opinion. So it's kind of that in-between gray time where it's not unqualified, but it's not adverse. They've done some things. Maybe there's one issue of material nature. Perhaps warranties weren't properly estimated, and both individually and aggregate, they rose to the level of a material misstatement, but it's only a one-off. Nothing else rose to that level. There might be a lack of evidence or scope restrictions on the audit, except for the fact that we could not go out and view inventory. Everything else looks good, but we're going to have to qualify our opinion because since we did not get to see inventory, we don't know if there's something there. And you have to disclose all the reasons of why it was qualified. We went to management and we wanted to look at the inventory. They refused to give us access. However, they did give us access, but it was in a location that we could not get to. Maybe it was out of the country and cost benefit says we can't do that. So we have to qualify our opinion. An adverse opinion is financial statements are not presented in conformity with GAAP. There may be material misstatements that individual or aggregated or both are material and pervasive. The finance statements may be prepared with that going concern we talked about in Chapter 14. And again, we need to disclose why this is adverse. Now, finally, there's one called disclaimer, and I have had to disclaim an audit in the past. And I can't provide an opinion. You just can't provide the opinion. And usually it's because there is an insufficient amount of audit documentation. For example, I was asked to do an audit on a small chapter of the American Red Cross. And when I went in there and I asked for the books and records so I could start doing my planning, they handed me one small box. Well, I knew one small box was not enough. And then they stated that there was a theft. Mysteriously, the day before my audit, there was a theft of multiple boxes of audit documents. Okay. In that case, I asked them, do you want me to go ahead and do you want me to withdraw or continue? And they said, oh, please continue. We need to have it for the main Red Cross. And I said, okay, but with this inability to review any documents, and we did go out and try to find some third-party documents, but there just wasn't enough. I wasn't able to form an opinion, and I had to just disclaim any opinion on here, and I explained what it was for so that they had something at least to send to their statewide Red Cross office. Another reason why you may have to disclaim an audit is because you lack independence. You are not independent from the client. And what you need to do is look up your state board and the AICPA's Code of Professional Conduct for what independence is and what independence is not. Where I would work, every year we would have to disclose who we invested with personally. If I invested in Starbucks, if I owned one share or 1 million shares, I could not audit Starbucks because I had an independence problem. If I had a key employee who was my spouse and I was auditing, I lacked independence. Normally the firm should remove you from the audit and put somebody else there. But at times you may not know until you get into it that there is an independence issue. And at that point in time, you have to file the disclaimer. Now there's the ASB of the AICPA and the IAASB put together these critical audit matters and key audit matters. And it's any matter that is required to be communicated to the audit committee. IAASP has different requirements than the ASB of the AICPA. So depending on what you are auditing and why, you may be subject to additional matters that you will have to bring up to and communicate to the company. One of the things you will also do in many financial statement audits is also evaluate the identified internal controls of the company and form an opinion individually and in the aggregate onto whether or not management has sufficient internal controls over the company. Now, you've got only two opinions. It's either unqualified, there's no material weakness, or there is one or more material weaknesses, not sufficient, significant deficiencies, but material weaknesses. When you do the audit report, you can combine the opinion of both into one of the reports. You would do the opinion of the financial statements, and then you would say, and we also audited management's assertions as far as internal controls. This is how we did it, and this was our opinion. My recommendation is that if you have an unqualified financial statement and an adverse internal control opinion, separate those out into two separate reports because you may want to put some additional information in there for clarity. At times, we're going to omit some procedures. We may go in at the beginning of the audit and say, we're going to do all of these substantive tests and procedures. However, when we get into the heart of the matter, we may inadvertently omit a procedure. We just forgot to do it. It happens a lot more times than you think. So the lead auditor should evaluate whether performing that procedure that you omitted would change the outcome of the opinion. For example, if you forgot to look at long-term notes payable, but it was one note payable, it was only going to go for maybe a year and a half, and it was a low level of amount on that loan, and you missed it, take into consideration, would expanding and going back into the audit likely change the outcome? And you might say, let's create that with a 100% material weakness. The whole thing's wrong. If we added that into the aggregate of what we already had as errors, would that put us over the top as to the tolerance level? If it doesn't, then you might not need to extend or expand your audit procedures. If it does, you might extend the audit to perform some additional tests. It's really a professional judgment call. So in wrapping up this last chapter, we talked about unqualified, qualified, adverse, and disclaimers of opinions. We looked at critical audit matters, CAMs and KAMs. We looked at internal control, and I want to caveat that to that is U.S. public companies, because that's a SOX requirement. And finally, we chatted a little bit about what happens when we omit audit procedures. As always, please read the entire chapter. There's a lot of information in there that I don't put in that level of detail in my videos. If you have any questions, please reach out. And if not, I'll see you in the classroom.